Okay, guys, so welcome to the day 4 of this YouTube mentorship. If you have not gone through the last videos, it's very, very important that you do so. Right, so do how to go through day 1, day 2, and day 3. And of course, do how to subscribe to the channel if you haven't, so that you'll be able to get the notifications of the next and upcoming videos. Right, so today we're going to go deep, right, really deep. Right. So today we're talking about liquidity, right? So first of all, you have to understand that liquidity is a very, very um large subject, right? It's not something that can be exhausted in one teaching, right? Um, just give me a moment. Let me. Right. So liquidity is a concept that is very, very wide, right? Because when it comes to liquidity, there are so many kinds of liquidity, right? So many kinds of liquidity. And we're just going to start the liquidity series today, right? I think this liquidity series might take maybe 3 days because we have to start breaking them down one by one, right? Some of the concepts are easy, some are, some of them are not so easy, but with experience and with time, right, um you get used to it and you begin to understand it, right? So liquidity, in my opinion, when you're defining liquidity, I define liquidity as what? A very, very simple topic. I define liquidity as what? Areas where, let's say, areas where money can be taken or injected. Right? This is how I view liquidity. Now, I want to make this very clear that liquidity, right, from the chart standpoint, right now, understand this, that when I talk about liquidity, I'm talking about liquidity from the technical standpoint, right? Technical analysis standpoint, right? This is the angle I'm coming from, the technical analysis standpoint, right? I'm not talking about liquidity from, the other, the broker standpoint and all of that, because if you're talking about liquidity from the broker standpoint, you're actually referring to money, right? How much is being, how much, volume is in the market, the volume of the market, the current just it was request of volume, like how much money is in the market at the moment. You talk about from the broker standpoint or from another standpoint, but from the technical analysis standpoint, we are looking at the chart now. So the areas on the chart where money is can be taken or injected. Now I'll explain that. Now, what do I mean by this? Now, as traders, there are places in the market where we want to, you know, we want to get into a trade. For instance, now let's say that you're a pattern trader, right? And then you see the market creating what? Something like equal highs, right? Double top, right? Now, what is the market doing this? You will say, okay, this is the first rejection. You'll be like, okay, let us say, okay, that you saw the market do this thing twice. Now you'll be like, okay, this is a first rejection. This is a second rejection. That means what happens? This becomes now what? A resistance level, right? So this is how you're going to view the market. Okay, this is a resistance level. So I want to sell if the market comes there again. So what do you do? You would be targeting this area to what? To do what? To inject your sell orders, right? So now this is what I mean. So this area becomes where you want to inject your order. That means you're going to be placing your limits here, or you'll be waiting for market to get here, and then you use your instant execution option. Now, when you instant execute, you have put your money into the market. You have injected your money into the market, right? So that is what liquidity is. Those areas that gives you that kind of conviction to put in your trade, put in your limits, right? So now those areas you put in your entries is also where is also where your money can be taken, because if this market goes south, what happens? You're going to lose money, right? That means if this thing goes south now, like the market does not do what you anticipate, this is good if it goes for your stop loss. Let's say maybe you placed a sell limit here at the open of this, and you are targeting the market to to give something good or something like this. And maybe put your sell limit here, and you are expecting price to push higher, right? And then price now comes. I mean, you are expecting price to push lower, and then price comes to your limit and then tax you out. What happens there? You have lost money. That means your money has been taken, right? So those areas where the market makes traders to enter those areas where traders like to enter trades, like there are areas in the market that people like to enter trades. Right? Depends on your strategy. There are people that trade trend lines now. Okay, let's assume that maybe I'm a trend line trader, right? I'm a trend line trader now. As well, I'm a trend line trader, right? So assume that maybe I did not catch this sell, right? Maybe I was looking for price to come to this trend line down here. And maybe I'm a trend line trader now. What will happen? I would, as price is coming back to this trend line, what will I do? I will put my buy limit there, right? So now this becomes an area of liquidity because this is where I am willing to get involved in the market, right? This is where I'm willing to get involved in a trade, right? So this is what I mean by liquidity, right? I'm referring to those areas where a trader wants to get involved in the market, right? A trader wants to get involved in the market. That's what I mean by liquidity, right? So that is it. I don't know why this buy limit tool is being so small. Let me just try one last time. And if it doesn't appear well, I'll just let it be. Right. So I think that something is wrong with it. So this is where I would like to be looking for my buy opportunities, right? Down there. Why? Because this is an area I expect price to buy from. Now that becomes what an area of what liquidity, right? So what happens there? If market comes there, I'm expecting price to buy, and then what happens? Market to take me out, right? Or even if it doesn't take me out, it goes in my favor. So that is it. So it's where price can either take you out or make you to enter a trade. So now liquidity is usually um liquidity is usually let's say synonymous with patterns, right? It's usually synonymous with patterns. So liquidity, when from the technical analysis standpoint, right, we are usually referring towards patterns in the market, right? So when you understand it, so we usually refer towards technical patterns, right? Chart patterns. So this is what we usually refer to when we refer to liquidity patterns because traders trade based on patterns. No matter how you trade, whether you trade smart money concepts, there's a model you use, right? If you trade trend lines, there's a model you use. If you trade support and resistance, there's a model you use. If you trade double top, triple top, there's a model you use. If you use cup and handle pattern, head and shoulder, whatever you use, harmonic patterns, they are all patterns, right? So we are all pattern traders, right? All traders, most of us really, we use patterns, especially if you use charts to trade, unless maybe you use fundamentals or macroeconomics. But as long as you focus on the chart analysis, you use a particular pattern. That is something that you were taught that you use as your criteria to enter a trade or to exit a trade. So we are all pattern traders. But the only thing that some people trade patterns that are flawed, why some trade patterns that are more genuine, right? So that's just a difference. Some people trade patterns that are flawed, while some trade genuine patterns, right? So now let us look at those patterns where a bit flawed, right? And that usually gets taken. So now we have understood this. Now let's start talking about liquidity, the kinds of liquidity we have. We have a lot of them, right? So I'll just be listing them out so you guys can just have an idea. So as in the first kind of liquidity we have, I don't want to type numbers. So you have what we call external and internal liquidity. So we have the external and internal liquidity. We have what we call the Asian liquidity. These are all liquidity. These are all kinds of liquidity. Right? This internal. Sorry. Let me just edit that. Sorry. Yeah. So we have that. We also have Asian liquidity. We have what we call previous you have session liquidity, each session, you have session liquidity. This one forms when sessions are forming, we have what we call previous daily high, previous monthly high. So we have previous candle high, right? So previous candle high. I have previous candle high or low. I have previous candle high or low. So I have previous candle high or low, which can also be a form of liquidity, which can also be a form of liquidity, right? So so we have the previous candle high and low, and now under this previous candle high and low, so now under this previous candle high and low, can I talk about daily? Can use daily candle. Have daily. You have the weekly. You have the monthly, and then maybe the yearly, right? Even 4 hour. These are all kinds of liquidity. Even 4 hour, 4 hour. These are all kinds of liquidity, right? This one they focus on candle, right? The previous day high, previous day low, previous week high, previous week low, previous month high, previous month low, previous year high, previous all those things. Right? We have 3 months, last 3 months high, last 3 months low, all those kinds of liquidity, right? So say kind of liquidity as well, right? So there are a lot of them, a lot of them. So I think these are the ones I can remember for now. If I still remember others, I will still add them. Right? These are the four basic kinds of liquidity I can remember. Now, inside these four classes, there are a lot of concepts to be understood when we are talking about these four. These are the four. When we are trying to, broaden the classification, like we want to make it broad. We don't want to talk too much, right? We just make it like this four: external and internal liquidity, agent liquidity, session liquidity, previous candle high or low, right? These are the four basic kinds of liquidity that we have, right? And then under these four, we now have, under session, we have London liquidity, we have New York, right? We have all those fun stuff, right? Then under external, we have inducement. So we have under internal, we have inducement, we have all those IDM, nice inducements. We have internal range liquidity. We have all of them, right? So let's start with the first one, right? We'll start with the first one. Let's start with the first one. So now let's start with the first one. The first one is what external one, internal liquidity, right? So let's start with the first one. And I think this is where we're going to focus our training for today. So now when we talk about internal and external liquidity, this one refers to what the range of the market, right? Refers to the range of the market, right? When we refer to this, we refer to the range of the market. Hmm. So that was internal and external. So we refer to the range of the market. So now, what do I mean by the range of the market? I mean that, let me just type it out again so that it will be easy for you guys to understand. So, for external and internal, so now we're looking at what the range of the market. So now, what do I mean by this? Now, remember what I taught you guys in the previous classes that we have what we call a bullish market. Remember what I taught you guys yesterday? I talked about the range, what a range is, right? Talk about what a range is, right? So I told you guys that a range is what? The distance between this protected low and this protected high. And I also taught you guys how to identify a range of protected low and a range of protected high. I told you guys how to identify when a low is protected and when it is, unprotected, right? So now I won't go over that again. So now we have our range high and low. So remember, I told you guys this yesterday. So I told you guys that you should mark this and this. This is not the common of your range. Now, how do we classify liquidity? Let me just do this thing properly. Let me do this properly. Sorry, let me do this properly. So we have the market, create this liquidity, and then obviously, market doesn't move smoothly, right? Obviously, market doesn't move smoothly, right? It doesn't move smoothly. The market actually moves. It doesn't move smoothly, right? So it's always going up and down. This is how the market actually looks like. Now, when this happens, what do you do next? Now you mark your range high and then mark your range low, right? This is our range high, this is our range low. Now, what is external liquidity? External liquidity is simply what? The extreme regions. That means below this um range low, we have external liquidity. So now below this range, we have what we call external liquidity. So let me make it smaller. So below this range low, we have what external liquidity, and then above this range high, and then above this range high, we also have what external liquidity, right? So it is here and there. So the extreme regions of a chart is what we refer to as external liquidity. That means if you are taking a trade now, maybe you are buying this market. Ideally, ideally, if someone is buying this market, ideally the person what stop loss will be what at this range low, because if you're holding this buy, your stop loss will likely be what below this low. You understand? If you're buying this now, your stop loss will be what above this low. That's why it's external, because it's outside the range. So this is the range between this purple line. This is the trading range. So any liquidity is outside this range. It's what we call external. It's outside the range. It's out of the range. All right. So if now we have gotten external liquidity. Now, what is internal liquidity? Internal liquidity is simply what? The liquidity is inside the range. So now, what do you mean? This is internal liquidity because why? It's inside this range. The range is between this purple line high and this purple line low. Right? This is the range. So this happened to be inside the range. That means it was internal. This also happened inside the range. That means it was internal too. So now these red lines are the internal liquidity, right? Because they are inside the range, right? So they're inside the range, right? They're inside the range, right? They're inside the range. So that's what we call internal liquidity because they're inside what the range, right? So let me edit that and make it clear for you guys. So internal, all right? So that is basically how this is done. So now we have the internal liquidity between that high and that low, right? So when that is done, we can now move to the next. Now, what is the importance of this? Now, what is the relevance of this? I don't say now. Now, the relevance is that whenever you're taking a trade, right, you want to make sure that you are not taking your trades based off internal liquidity because internal liquidity has every tendency to be violated. That means market can always violate this. Now, this is what confuses a lot of traders. Now, if price goes below this low now, some people will be like, okay, the market has changed trend. No, the market only changes trend when it goes below what? External liquidity. So liquidity also helps you to know if the trend is intact. Price going below this does not mean that price has changed yet. Price going below this doesn't mean that price has changed trend yet, right? Price has most tendency to take out internal liquidity for doing what? Going for external. So this is how the market actually moves. So the market goes from the market moves. Market goes from what? Internal liquidity to external. And so the market actually moves, right? So this is the market moves. So your high probability trades are taken when price has taken internal liquidity, and now I cannot expect to go to external. So the market goes from internal liquidity to external to internal to external to internal to external, right? So that's how the market moves from internal liquidity to external, from internal to external, from internal to external. That's how market moves. So now once you're taking internal liquidity, what's the next thing it goes? It will go for what? External, right? Let's just do that properly. So it will go for what? External, right? So go for external liquidity. Now, once it's taken out external liquidity, what's the next thing? It will come back for internal. So the cycle continues. So it will come back for internal liquidity again. So now, what's the benefit? This one here. It will take out this internal liquidity, take out this other one. So also know that it doesn't always take out all of them. Sometimes you cannot take out two. Take out this one, take out that one, then maybe time this one and then move along. So for your trading rule, always wait for price to take out internal. If you're looking to take a trade in line with the trend, wait for internal liquidity to be taken, right? All right. So wait for internal liquidity grab. So for you to have those high probable trades, always wait for price to take out internal liquidity before looking for what a buy. If you're bearish, look for market to take out what external liquidity before looking for what a sell, right? So now, this is a best example now. Remember I told you guys that bracket moves from external to internal. So as price is going downwards, it's going to pull and take out what internal liquidity first. Take out this one, first take out that one, then what begin to drop for the external liquidity. And then what happens next? It has made what a new external liquidity here. And now, what happens? It's not good for this one. This time becomes what? Internal, right? And now this now becomes a new external liquidity because I think that when market makes a new though, it makes what a new internal liquidity. So now this now becomes a new external liquidity because price was made a new though. So now this now becomes a new external liquidity and this becomes a new lower external liquidity, right? So now what happens? Price push above this high, taking out internal liquidity for the what making what a new low. So always wait for the market to take out internal liquidity before basing your trades, right? To help you to filter out losses, right? It will help you to filter out a lot of losses. A lot of losses can be avoided when you wait for internal liquidity to be taken first, right? Always wait for that to be taken before looking for what your buy continuation, right? It's very, very important that you wait for price to take out internal liquidity before looking for your buys. If you're bearish, wait for it to take out internal liquidity before looking for your sells, right? It's very, very important because it helps to filter out the noise, right? Now, there are also cases where price won't take out internal liquidity, right? That doesn't mean that your concept is wrong, but your goal as a trader is to focus on what is in your trading rule. And one of the things that should be in your trading rule is what? If I don't see internal equity taken out, I don't have a trade, right? Just be disciplined that way. That if you don't see internal equity taken out, then you're not going to take a trade, right? It helps to just fit out, you know, the good moves from the bad moves, right? So let us look at an example of it on the rate chart, right? Let us look at it on the rate chart, right? Let's look at it on the rate chart, right? So now this is a very clear example. So look at this market now. We have external liquidity here and then external liquidity, right? Look at this is a very clear example here, right? So can you see that? So this was the external liquidity and this was also the external liquidity too. Now imagine that you are trying to buy this market here. Now look at this chart. Look at what I'm explaining to you. Now imagine you try to buy this. Maybe you say, okay, this is another block now, and you try to buy it. You're taking a loss. You try this here. Imagine you also try to buy at this point here. What happened? You are taking a loss, right? But immediately price took out all this liquidity. What happened next? It tapped into this order flow. Don't worry, tomorrow I'll teach you guys about order flow. So this last push down was the order flow. Immediately market took out all this internal liquidity. What happened? The market was bought and then made a new high. So you can see a very clear example of what I've been talking about here, right? Once price take out internal liquidity, then it's ready to continue forward a buy, right? So look at this example here as well. Let's look at this example as well. So this was the range high. This was the range low, right? This was the range low, and then look at the range high here. This was the range high. Sorry, trying to get something. Right. So this was the range high of this one, right? Somewhere around there. So what happened? Can you see this liquidity that was built here? So we had kind of internal liquidity formed here. Look at this. So you can see how price took out this internal liquidity. When see price took out internal liquidity, what happened next? It started by right. So as the market see what the market did. Let's look at this. So this was the market. The market did something like this. We saw our high, we saw our low, we saw our high, we saw our low, and then we saw our new high. So what happened? The market took out what? All this external liquidity, took out this internal liquidity, took out this one, then what happened next? It bought. So you can see what I'm talking about, right? Now, note something that the last internal liquidity is actually the one that actually triggers most trades, right? So if you have like let's say five internal liquidity now or six, right? Maybe you have five or six. Always target the most extreme one. So this one was one that you really pay attention to. This last one here, right? That is where price usually reverses from. Once price takes the internal liquidity, it has a very high probability of continuing upwards. So what do I mean? When if you're in a bullish market now, right, and then you see the market create, let's say this, and the market create, let's say first liquidity, second liquidity, third liquidity, and then makes external liquidity. So the market is coming down to take out internal now, right? What is likely going to happen? This last one is usually where price reverses from. This last one here. This is where price usually reverses from. So market likes to reverse from this last one. All right. Now note this. It is not it's not in all cases that this happen. It's not in all cases that it happen. Not in all cases, but in most cases, price usually reverses from here. Once it happens, it moves back. So the reversal or continuation usually occurs after the last internal liquidity is taken out, right? So this internal liquidity can also be referred as what? Inducement. So we refer to this last one as what? This we refer to this last one as what? The last inducement. So you can internal liquidity can also be called inducement, right? So internal liquidity can also be called inducement, right? Internal or inducement. We call it inducement, right? So because it induces you to take a trade before it is ripe, right? So now this last one is usually what where you see what reversals, right? So if you got this video, if you go to this part, just type it in the comment section. The last inducement or the last internal liquidity is where price usually sees a continuation, right? That is where price usually sees a continuation from there. Once price take that last one, that is where you usually see what? A continuation, right? So that is how to classify internal liquidity. This is how it is done. Nothing more than this, nothing less than this. Right. So we're going to be stopping for today at this point. I want you guys to go and look for, if you watch this video to this point, go and look for I showed you guys bullish examples. So show me two bearish examples and tag me on Twitter. So show me bearish examples of this where price took out liquidity before continuing. So just show me two examples from the bearish side, right? So please do want to subscribe to this channel, like this video. This is the liquidity introduction. Tomorrow we'll continue with other forms of liquidity, right? So I'd love to see you guys in tomorrow's class. Have a wonderful day. Cheers and God bless.